I'm sure you've seen the headlines. Inflation is up more than expected in March, the highest increase in 6 months, which puts into question whether or not the Fed will be cutting rates in upcoming months. But what if I were to tell you that the inflation data we're being fed is based on bad data and bogus numbers? I'm Sam Kovacs, co-founder of the Dividend Freedom Tribe, and today I'll be walking you through this. So, yes, the inflation has increased to 3.5% in the past month. As you can see here on this chart, it's the biggest uptick in the past 6 months, although the core CPI, so the backing out food and energy, has been somewhat stable and bumbling along nicely. Yet, food and energy are not the point of today's discussion. It's all going to be focused on rent and owner's equivalent rent, as shelter costs are keeping inflation arbitrarily and infactually correctly high. Why so? First, let's understand what goes into the CPI. This graph here is a little dated, but it shows very well how the CPI is broken down. Shelter is a very big part of the consumer price index. Food is second, and then we have energy and transportation close third and fourth. These numbers are dated, but it shows visually nicely what's going on. If we go to the more recent numbers here, we can see that shelter currently is in fact 36% of the consumer price index. Why is this important? Because year over year, shelter has increased 5.7% according to the BLS. This means if we back out the math, and I didn't actually have to do the math myself here, but that the contribution of shelter to inflation was very high, and that all of the components, excluding shelter, would have only increased by 2.2% year over year, which is pretty much in line with the Fed's target of 2% inflation. Now, of course, media thrives not on facts, but on fear. So the second they have a headline which can grab attention along the lines of rates won't be cut, economy is uncertain, inflation is up more than expected, you can be sure that they will use and abuse it. However, what you need to understand is that these shelter numbers don't tell the whole story. The reason is that shelter numbers, as you can see here on this chart, are sticky. It takes a while for inflation to show in shelter, and then it takes a while for it to move out. Why is this the case? Because leases are usually signed yearly for rent, or maybe bi-yearly, but it takes a certain lag for these transactions to come through. So as we could see here, there was a huge spike in 2021 and 2022 in price of new rented apartments, but this only really backed into the shelter component of the CPI much later. And as you can see, the increase in rents came dramatically down and peaked a whole 16 months before the CPI component peaked. And now apartments listed in the US are actually negative. So new leases are actually cheaper than they were 1 year ago. But because leases don't come due every day, but they're stacked over time, there's a certain lag, and therefore this number is staying extremely high. The second aspect of this, which we'll get to in a bit, is that shelter isn't only composed of rent; it's also composed of this survey data that's called owner's equivalent rent of residences. What they're trying to measure here is what would someone be paying for rent if they didn't own a house and had to rent a similar place. Now, this is survey data. It's unreliable at best, and I'd suggest that it has a lot of bias. And what we've clearly seen, and there's this nice chart here that shows this, is that if you have housing prices lagged 18 months and inflation of the owner's equivalent rent, correlation between both. And as we've seen, house prices have come down, and we can expect multifamily and apartment prices to come down more in 2024 as massive supply comes onto the market and rates stay elevated. That invariably, over the next 6 to 12 months, owner's equivalent rent is going to have to come down too. So what should we get from this information here? As we see here, the CPI component of shelter has a much thicker tail and a much lower high than the distribution over time of increases in rent, which spiked quickly and then fizzled off. But if rents across the board were reflective of the most recent increases, then CPI would already be at the Fed's target. It would already be at 2%. Yes, gasoline prices have increased and have led to a slight increase, but we always know that there's going to be some volatility in energy prices. And in the current fiscal environment, these will not be enough to spark a new bout of inflation by themselves. And therefore, the reason that the Fed's not using CPI but using PCE is because the consumer price index is misleading. It's showing you sticky data, lagging data from these real estate numbers, which just doesn't reflect the reality in the markets. I believe that the Fed should be able to see beyond this and continue with its plans of cutting rates either in May or June, and that anyone betting against this is betting on stupidity. Now, the Fed have shot themselves in the foot a few times in the past, so I wouldn't put it past them to do it again, but I highly suggest that they see the forest from the trees and address rates in the upcoming months so that the wall of debt that's coming in commercial real estate and in consumer loans doesn't kill the economy and that we can still achieve a soft landing. I'm Sam Kovacs. If this video was helpful, please click the subscribe button below and make sure to be on the lookout for future videos. Have a great day.